Let's jump right into this explainer. We are looking at a massive, high-stakes battle that has been raging on Wall Street for decades. Investors have always been chasing that golden goose, that foolproof way to know exactly when to buy and sell. Today, we're going to break down the two completely opposite philosophies that came out of that quest.
Here's how we'll break it down today. Section 1, the biggest game in town. Section 2, technical analysis and charting. 3, fundamental analysis and value. 4, the 4 rules of valuation. And finally, Section 5, the limits of prediction. Let's get right to it.
Section 1, the biggest game in town, with high stakes and the efficient market buzzkill.
Now, to really grasp why these theories even matter, we have to talk about the sheer size of the arena. Back in 2006, on a typical day, just on the New York Stock Exchange, a staggering $100 billion changed hands. And that is just one exchange. Throw in the NASDAQ, global markets, futures, the whole shebang, and you're talking trillions of dollars moving every single day. The payout for getting it right is, frankly, enormous. That's exactly why the sharpest minds out there are constantly trying to crack the code. But, well, what if the code literally can't be cracked?
Enter the academics who are here to crash the party. They've got this concept called the efficient market theory, and it basically says predicting the market is a fool's errand. They break it down into 3 versions. The weak form argues that the market is just a random walk, meaning what happened with a stock yesterday tells you absolutely zero about tomorrow. Then there's the semi-strong form, which says that by the time you're reading the news, the market's already priced it in, so your edge is gone. And the strong form, that one claims that absolutely nothing, not even top secret insider info, can give you a real predictive advantage. So if the academics are right, you might as well just throw darts at a board, right?
Section 2, technical analysis and charting, the 90% psychological approach.
Okay, despite what the academics say, the pros are definitely still trying. This brings us to the Great Divide. On one side, we have the technical analysts, or chartists. They operate on what's called a castle-in-the-air view. They figure the market is about 90% psychological. Honestly, they couldn't care less what a company actually makes or sells. They just study past price movements to guess what the crowd is going to do next. On the flip side, fundamentalists take a firm foundation approach. It's 90% logical. They want to know the intrinsic value of a business, things like growth, dividends, and real-world risk.
To give you an idea of just how hardcore the chartists are about ignoring the real world, let's look at one of their pioneers, John Magee. This guy literally boarded up the windows of his office. Why? Because he didn't want to be tempted to buy a stock just because it was a sunny day, or sell because it was raining outside. I mean, talk about commitment. To a pure chartist, if a stock chart looks like an inverted bull, it means the exact same thing whether we're talking about Microsoft or Coca-Cola. The actual business? Totally irrelevant to them.
So what are these chartists actually looking for? Well, it's all about finding a trend. They'll literally draw lines connecting the tops and bottoms of a stock's price movements to form a channel. The whole philosophy here is that a body in motion stays in motion. Market momentum perpetuates itself. As long as the price keeps bouncing between those two lines, they see a bullish signal. It's essentially a bet that the psychology of eager buyers is just going to keep pushing that price higher and higher.
But of course, they also need to know when the party's over. And that brings us to the famous head and shoulders pattern. To a chartist, seeing this form is like a surgeon looking at an X-ray. You've got the stock rising to a left shoulder, peaking at the head, and then dropping to form a right shoulder. The absolute critical moment is when the stock drops below that flat bottom line. They call that piercing the neckline. When that happens, alarm bells ring. It's a massive bearish signal telling them the market has topped out and it is time to sell immediately.
The catch, though, is that the market absolutely loves to break its own rules. Sometimes, a chartist will see that clear sell signal, brace for a crash, and then the stock suddenly skyrockets. They affectionately call this the bear trap. And it really highlights the biggest vulnerability of charting. Because you're waiting for a pattern to fully form or break before you make a move, by the time you actually do something, the market might have already aggressively changed direction on you.
Section 3, fundamental analysis and value, the 90% logical approach. Let's shift gears completely and talk about the fundamentalists. These folks don't care about price momentum at all. They care about actual worth. There's this great anecdote from a Texas broker back in the 1930s. A client was livid because he was sold a stock at $760 when it was trading somewhere else for $730. The broker's response? He said they select investments based on value, not price. And that right there is the whole bedrock of fundamental analysis. They refuse to get swept up in the crowd's crazy optimism or pessimism. They aren't buying a price tag. They're buying intrinsic value.
So, instead of breaking out a ruler and drawing lines on a graph, the fundamentalist is digging into the hard numbers. They're looking at four main things: the expected growth rate of earnings, the expected dividend payouts, prevailing market interest rates, and the actual degree of risk associated with that specific company. Basically, they're acting like financial detectives, sifting through balance sheets and income statements to figure out the exact stream of cash an investor is going to get down the road.
Section 4. The 4 rules of valuation, or the determinants of intrinsic value.
Let's see how those factors translate into actual rules for buying stock. Rule 1. Higher expected growth means a higher price tag. Rule 2. Higher expected dividend payouts also equal a higher price. Rule 3. Less risk. You guessed it, higher price. And Rule 4. When general market interest rates are low, stock prices tend to be higher, mostly because safe bets like bonds just aren't paying out much. So if you put it all together, the holy grail for a fundamentalist is finding a high-growth, high-dividend, low-risk company while interest rates are low.
Let's drill down into that first rule about growth, because this is where the real magic happens, the magic of compound interest. Take a look at that middle row. If a company manages to sustain a 15% growth rate, a $1 dividend turns into $2.01 in just 5 years. Think about that. Your payout literally doubles in half a decade. Keep that going for 25 years, and that single dollar becomes almost $33. This is exactly why fundamental investors will obsess over finding companies with massive long-term growth potential.
And it's not just theory. The market genuinely behaves this way. You can see here that companies with higher expected growth rates command significantly higher price-to-earnings multiples. We're talking about heavy hitters, from Exxon to Google. Investors are fully willing to pay a massive premium today, essentially buying the stock at a very high multiple, purely for the promise of those massive, compounded earnings tomorrow.
Section 5. The limits of prediction. Why crystal balls are cloudy.
Now, before we get overly confident in these rock-solid valuation rules, we need a reality check. The glaring flaw with fundamental analysis is that it relies 100% on estimating the future. You're taking totally unprovable guesses about what a business might do 5 or 10 years from now and trying to calculate a precise dollar value for it today. And honestly, even the smartest folks on Wall Street get caught up in wild optimism like we saw in the dot-com bubble or crippling pessimism during crashes. It's just incredibly hard to stay objective when real money is on the line.
There's a great, slightly cheeky quote from Samuel Goldwyn that hits the nail on the head. Forecasts are difficult to make, particularly those about the future. No matter how perfect your math is or how beautifully drawn your charts are, we don't have crystal balls. You could find a company with an absolutely flawless foundation, but a sudden shift in technology or some random global event can completely rewrite its future literally overnight.
So, as we wrap up this explainer, I want to leave you with a question to mull over for your own portfolio. Which of these philosophies actually makes the most sense to you? Are you siding with the chartists, making bets on the predictable psychology of the crowd, or are you a fundamentalist, putting all your faith in cold, hard business metrics and growth? Or do you secretly agree with those academics that it's really just one big random walk? Thanks for tuning in, and remember to always keep questioning the numbers.